Hey everyone, and welcome back to the Rate of Return podcast, a 30-minute podcast whose entire purpose is to equip you with the tools and resources to become the best financial version of yourself, from investing in the stock market or real estate to cleaning up your personal finances, putting you on track to become a millionaire. The Rate of Return podcast exists to give you actionable insights you can work toward today. Joining me is the co-founder and managing partner of NEOS Investments, Troy Cates. NEOS Investments is a global asset manager that has set out to enhance investment portfolios with the next evolution of options-based income solutions. We're going to talk all about that and what that means. So if that threw you off there, just hold on here. But specifically, they have 3 ETFs trading on the stock market right now, all 3 of which seek monthly income for their investors. So for those of you listening right now that are looking for that passive income, be sure to pay attention. Before we break down all these ETFs, what they do, all the fun stuff about them, I want to give Troy an opportunity to introduce himself, expand upon his background a little bit, and walk us through how he ended up at NEOS Investments. So Troy, thanks so much for hanging out with us, man.
Yeah, thanks for having me. This is great. Happy to be here. To give you a little background of me, I've been in this business for over 25 years now. So started out in the late 90s on a trading desk. Back when you actually had to use paper tickets to trade orders and get orders to the trading floor. So it's been an evolution. And for the first, call it 10, 15 years of my career, I spent it on that side of the business, more the market making, trading equities, options, and eventually moved over to the asset management side. So our team here at NEOS has been working together for more than a decade at various different firms. We had a bunch of us had owned a firm and sold it to a large Asian bank years ago. And with that sale, we basically pioneered the option-based ETF space. So we had brought out a number of ETFs probably about a decade ago that we eventually sold to this firm, and they're still out there in the marketplace. They were passively managed option-based, basically buy rate strategies. So kind of version 1 of the option-based ETFs that you see out there in the marketplace, but they're still out there. They're still very large ETFs. And as we were growing in different facets of the business, some of us were on the hedge fund side, some of us were more on the institutional side. We wanted to put the team back together and start NEOS, which we started this past year, and bring out some option-based ETF strategies and focus on the income space, which is where we really kind of started in the business, bringing out, ETFs that pay monthly distributions, can fill a need for somebody looking for a monthly, dividend, and still have some exposure to the underlying indexes that we use, whether it's equities in the S&P 500, or whether it's core bond, or whether it's just a cash alternative, someplace to park your cash, but earn a little more than what cash is paying you right now. And, call it a savings account or something along those lines.
Got it. Okay, so you talked a lot about the options-based stuff, and that's something I really want to get into. I want to dive deeper into these ETFs specifically. So let's start with that. The first ETF listed on your website is described as S&P 500 high income with a dividend yield above 12% as of January 31st, which is insane to me as someone who's looking for these 3.5%, 4.5% dividend yields and thinking, oh, that's great, right? Or 3M right now, they're paying like 5.5%. It's like, this is crazy. 12%. So walk me through exactly, Troy, how is this achieved and what exactly needs to happen to generate a 12% return?
Yeah,
or 12% yield. I'm sorry, 12% yield.
12% yield. Yes, we pay. So this product is a monthly distribution. So we pay 1% a month. And how do we do that? We are long the S&P 500 underlying names. So we're long all 500 plus equities that are in the S&P 500 in the same weighting. We track that index. We rebalance, add, delete when they add, delete. So we're not trying to change anything from an underlying equity beta standpoint. Where we bring the value add in is the option portfolio. So the option portfolio can toggle between a couple of different models. And right now it's currently in a laddered short call model. So what I mean by that is on a monthly basis, we're selling upside index calls on the S&P 500. And we are bringing in income by selling those calls. On average, we're selling those calls 2 to 4% out of the money. We roll those monthly. and the duration is usually about a month and a half or so. So as we look at that with those, that laddered short calls that we're selling, we're bringing in that income. That income we're bringing in is used for the monthly distribution. So we're trying to bring in that 1+% a month to use as a distribution. And at the same time, with our rules-based model that we're using, we don't have to necessarily write calls on 100% of the notional of the portfolio, which is really nice. On average, we've been writing calls on anywhere from 65 to 80% of the portfolio, which leaves the other part of the portfolio uncapped to appreciate with the market. So that's something where we built this product for upside appreciation while still providing a monthly distribution. So on months where the market kind of moves higher, the S&P has a really nice upside, we're capturing anywhere from 65 to 80% of that upside with the market while still paying that 1% distribution on a monthly basis. Now, the model is rules-based. It's all systematic. Everything we do is based on back testing and building probability analysis of what things might do in certain volatility regimes. When you're looking at the option market, you're looking at a lot of different things from volatility to the Greeks of the underlying options. And we build our models based on that volatility probability. So where we are right now with where the VIX, which is volatility on the S&P 500, where that currently is, we're in that short call structure. But if we were to get back to where the VIX was very much lower than it is now, sitting at a 10 or 11, that might put us into a call spread where we're selling a call and then buying a further upside call to possibly have participation if the market moves higher. So it's a very dynamic model, but it is rules-based and systematic in the sense that we're rolling it on a monthly basis. So people get comfortable with that. It's not, we have 3 portfolio managers here, including myself. It's not somebody coming in and taking discretion and buying and selling calls on the portfolio.
Not buying and selling calls on a portfolio. It sounds like me having a bad week, just saying, you know what, I'm just going to buy and sell these calls and see what happens, right? Okay,
Yeah.
glad to know that you guys aren't doing that.
I think a lot of people did that over the past couple of years, so don't feel bad about it.
So let me just kind of break this down how I understand it. What I heard was you guys are long the S&P 500, which means I'm assuming you guys just own all the companies in that, or are you like leverage long? You're just normally long, right? You just own the stock.
We are long. There's no leverage in any of the portfolios. So we're long the S&P 500 names. Yes, every company. We're not doing it through an ETF or anything like that.
Got it. So you guys are long the S&P 500. You own all the names, all the companies. That's great. And so now what you're doing is you're saying, okay, you're going to sell, you sell, right? Call options. So you're going to sell call options that's expire. Is this a monthly expiration date?
So we're using the regular monthly expiration, but since we're rolling at the end of the month, we're going out about 6 or 7 weeks to the next month's regular expiration, which is the third Friday of every month.
Got it. Okay. And then you said that the strike price is about, I think you said 2 to 4% higher than what it is.
Correct.
Do that a little bit again? Yeah.
So you take where the current spot is of the S&P, and the model will usually pick a couple of different calls to write. It's not just one call. So we're selling multiple calls, and they'll be anywhere from 2 to 4% out of the money on average.
Got it. Okay.
You'll get that upside move. If the market moves slightly higher, you'll appreciate with the market there because you're not capping yourself until you're at that 2 or 3 or 4% out of the money area.
Right. And it's also, I mean, maybe I don't know the stat here, right? But I'd imagine it's also pretty irregular for the S&P to jump 2.5%, 3.5%, 4% on a monthly basis, right? Just go straight up. I mean, we obviously happened in January, but kind of to go against that, right? Let's say that does, and you guys have to actually kind of act upon those calls that you had wrote. You also have, I think you said, about 20% of your position is also in the S&P 500. So you see the upside as the S&P kind of goes up, kind of like a hedge, I guess, against the calls that you're writing.
Yeah, so that makes sense. So if you think about it, we built this, like I was saying, for market appreciation. So in a month like January, where the S&P is up over 6%, this fund was up over 4%. So it's capturing 2/3 of the upside in those big upside months. Because part of it is uncapped, and we didn't write short calls on it. And the other part is that the calls were laddered out of the money. So you get that really nice upside appreciation. And that's what we were really building the product for, because It kind of fits into your equity portfolio if you're looking for income. But at the same time, you want to be involved in the markets. A lot of the passively managed strategies that we brought to the marketplace years ago, that are still out there, they're all, at the money, kind of capping your upside. So we were looking to do something a little more, where we get more upside appreciation.
Got it. Okay. You walked us through that very well, Troy. I really appreciate it. Now the second ETF, right? So the second ETF that you guys have listed on the website is called the Enhanced Income Aggregate Bond ETF. Now, I could be wrong here, but didn't bonds get crushed in 2022? Have they bounced back? Like, what's sort of the, I guess, vibe of the bond market right now? It's not something that I'm actually like following too closely. And so, like, one, what is that? But then also, like, how does that fit into someone's portfolio? Should people be investing in bonds in 2023? Obviously, I'm not asking you for investment advice here, but is that something people should have on their radar?
I think it's something everybody should have on their radar. Yes, bonds did get crushed last year, so everybody talks about how the 60/40 model is broken. I feel like it's probably been broken for a while, with interest rates that were at zero for a long time. So now we're getting into this market where you can actually earn something on your bond income portion of your portfolio. And it also depends on where you are in your investor lifespan. If you're young, you're looking for more growth, you're probably less invested or less thinking about, should I have a bond portfolio? But if you're older, retired, and you're looking for more income or more steady income, you might want to think about that. So with this product, with BNDI, like I said, all three products, we're looking to slot into anybody's portfolio. So for BNDI, it's kind of the core bond section of your portfolio. And when we were building it, we were looking to provide an extra 200 to 250 basis points above what aggregate core bond was giving in the marketplace. At the time, it was around 2.25. Now it's higher, closer to 3%. So with what we're doing, we're selling out of the money put spreads on the S&P 500, which brings in a long equity component to the portfolio. And that's how we bring in the additional yield over what ag is currently giving. So the portfolio is long, two of the biggest aggregate, core bond ETFs, AGG and BND. And then we're selling these out of the money S&P put spreads. We're selling them with a 2-week duration, and we're rolling them weekly to move with the markets. And as we've seen, the S&P moves quite a lot, sometimes intra-week. So we wanted to make sure that while we have these S&P 500 put spreads out of the money, that they're not just stale and sitting there for 3, 4, 5 weeks or something like that. We want to move every time the market's moving. So we decided to roll these weekly. And all we're trying to do is get that extra 2% a year over what ag is giving, which puts us in this, 5% yearly distribution that we're looking at. So it's a really attractive product for people that have a core bond portfolio, but want to add a little more income to it. And as we say with all these products, that we're not looking to replace your equity holdings or your bond holdings or anything like that. But if you wanted to take a little bit of your value equity portfolio and put in SPYI, or the same with BNDI for your core bond, you would lower your volatility while increasing your income. So that's where we kind of look at it and talk when we talk to people about it.
Yeah, I think that's like the real kind of money shot here is back to SPYI for a second. If the market, like you said, is up, I don't know, year to date, call it 7%, 6 or 7%. And I'm sure, you just mentioned here 4.5% or so for your own thing, right? It's like you guys are not only providing a 12% yield, cash on cash, right? That's crazy to me. But you're also saying we also see the upside, right? If you want to move up and down the ebbs and flows of the markets, we can provide that as well. And, to your point, less volatility. But then also, there's the opportunity to have income, which is incredibly important for a lot of people, especially I think those listening right now. We have sort of this here at Rate of Return. I've been working toward a $2 million dividend growth portfolio. And so the goal is over the next 10 years to have a $2 million dividend growth portfolio that pays between $80,000 and $90,000 a year. But to get there, I'm aggressively investing into companies who are paying and raising. It's all about raising the dividends every single year. really aggressively, right? 10, 15, 20%, 5-year CAGRs. And so I'm a big believer in the passive income and the dividend portfolio and all that stuff to truly reach financial independence before 59 and a half, right? I think a lot of people mistakenly dump hundreds of thousands and millions plus dollars into their retirement accounts through 401ks and SEP IRAs and solo, all these, IRAs and all these other different things, not knowing that, maybe you have a windfall and 45 or 50 years old, technically could retire if you had the income instead, or you don't have to wait that extra 10 or 15 years to truly be able to touch that money. Next question here I have for you, though, is the third ETF that you've got, this cash alternative ETF. I've heard a lot about high yield savings accounts recently. I think everyone and their mom is looking for a good high yield savings account to park their cash. Personally, I'm using M1 Finance. They pay 3.5% or so. Wealthfront, I've also seen my girlfriend uses them. They pay about 4. I think public.com just came out with a treasuries product that pays 5. So a lot of people are trying to figure out where can they park their money to get this 3, 4, 5% sort of yield, risk-free yield, right? These, like I said, these are paying some insane amounts, but what's the difference between like a high yield savings account that I might put, my money in on Wealthfront or M1 Finance versus what this ETF is? Can you give us the kind of difference there?
Yeah, sure. I'll give you, if it's all right, I'll give you the kind of quick background of how we developed this product. So when we were looking to develop this product, a year ago, we wanted to find a way. We talked to a lot of not only advisors, but we talked to a lot of private equity shops, a lot of VC shops, and they sit on a lot of cash. And at the time, they're earning nothing on it. So we're like, how can we develop a portfolio that could yield very conservatively an extra, 1 to 1.5% a year and pay that out in a monthly distribution? So we developed this product where we're rolling 90-day T-bills and using that as collateral and selling out of the money SPX put spreads. So very similar to BNDI, but we're selling further out of the money. So on average, we're selling anywhere from 8 to 11% out of the money on a weekly basis. So very similar strategy where we're rolling weekly, durations 2 weeks, but we're selling 8 to 11% out of the money. So the risk is very dampened and volatility is very low because of that weekly roll and how far out of the money we are. And so we developed the product to give that extra 100 to 150 basis points. And then we launched the product at the end of August. And because of rates obviously moving higher with the Fed and what they're doing to try to dampen inflation, T-bills were yielding like 2.30 at the time. So we're like, all right, now we have this product that could spit out, close to 4%. This is amazing. And here we are with treasuries yielding 4.5 to 5% now. And we're still doing what we're doing on the put spread side. So now we have a product that it's the forward distribution yields over 5.5%. And it's really just invested in treasuries, which are guaranteed by the US government, and these deep out of the money put spreads. So this product has been very attractive to a lot of people that have been sitting on cash. And to get back to your question on how does this compare to, say, a high yield savings account, or I haven't heard the phrase in so long, but I was recently in a bank and I was sitting there and somebody was there trying to purchase a CD, which I haven't touched or seen since, to be honest, I had a CD once and it was 1989, and I used some money and put it away in there. But yeah, those products are now yielding, like you said, 3.5 to 4%. So this product's a little different that it is, it's professionally managed. It's an ETF. It's got a fairly low expense ratio at 38 basis points. And it's a product that you could be in and out of. It's not locking your money into anything at any point. Just like any other ETF, you could park money there, keep it in cash, get that monthly distribution, and take it out when you need the cash. And I think it's something important as we talk to advisors and different investors that do sit on a large amount of cash, especially after last year. We've talked to so many people that pushed money down, into cash because they weren't sure where the market was going and didn't want to have their clients lose too much money. And this kind of is for us and for what we kind of talk to them about is a really attractive product to kind of park your cash in for a little while. It lowers your volatility. And overall, you're going to get that monthly distribution, which now is because of where the treasuries are, it's putting out over 5.5%.
Jeez, that is insane. And yeah, no, it's so funny. I have a local Bank of Tennessee is where I bank, and I have a savings account with them, and I saw little interest payments coming in, and I was like, I wonder what the math is on this, and it was nothing. So I go to
Yep.
the branch. I'm like, hey, do you guys have like high yield savings accounts? No, never heard of that one. No,
That's
no,
what
we
your
don't have that
special
here.
customers. Yeah.
Yeah, yeah, exactly. That's for the millionaires. I'm like, okay, well,
Yeah.
I guess I don't matter, right? And so that's so cool that you guys now offer this product that it's one, it's completely different from a high yield savings account, but two, it pays even more, right? That's so fun.
Yeah.
And so from that perspective, just as a quick follow-up question, I'm curious, like when people are saying like, I got the chart here pulled up for CSHI
Yep.
is the ticker for you guys listening right now. It's the NEOS Enhanced Income Cash Alternative ETF. I've got the chart pulled up and I'm seeing it does like these little jagged things, right? Like the price goes up by maybe 10 cents, and then it quickly drops back off levels, goes up. It kind of does this up and down. It looks kind of like a sawtooth. Can you walk us through why it does that?
Yeah. I mean, I can't see the chart you're looking at, but if it's looking at it on a monthly basis, you might be seeing the price change
It is,
from
yeah.
when we
Yeah.
go ex-div. And so we pay the distribution and it brings the price down. And then it continues to appreciate higher after that. And like I said, it's long treasuries, and we're selling deep out of the money SPX put spread. So it's a very low volatility investment.
Absolutely. Absolutely.
There is some added risk to it if you were just on your own rolling T-bills and trying to get that, 4.5% that currently T-bills are paying. It does have that added risk of the S&P put spreads, which are bringing in, as we discussed earlier, a long equity tilt to it to bring in that extra income. But I think the people we've been talking to, whether advisors or others, are willing to take that little bit of risk over what they could do with their treasuries to get that monthly income.
Makes total sense. And you mentioned the expense ratio before that being 38 basis points. For the people
Yep.
listening right now that might not be familiar with what an expense ratio is or how that gets paid, can you walk them through that quickly?
Yeah. So when you're purchasing an ETF like CSHI or any other ETF, there is some sort of an expense ratio or a management fee, if you will, that's paid to the advisor who's managing the portfolio. And it's not something that comes out of your account or anything like that. It's calculated daily by the fund accountant, which is usually a large bank. In this case, we use U.S. Bank fund custodian, and there are administrators. So on a daily basis, they're calculating NAV and also calculating the daily expense ratio into that. So 38 basis points over the entire year divided by 365 days comes out to a very minor adjustment to NAV on a daily basis. So it's nothing that anybody sees come out of their bank account or a fee like you would if you were just had something in your checking account and they charge you for something. So it's nothing like that.
Got it. Got it. Very cool. Thanks for walking us through your three ETFs. I'm certainly intrigued about that first one, SPYI, and certainly this cash one as well. Bonds, maybe, but I think this cash one is really interesting.
Yeah.
So before I kind of wrap us up here with our final question, I want to ask you now kind of a quick, just general thesis idea of like, who is this like perfect customer that's going to be using all these, right? We kind of talked a little bit about the person who's looking for income and upside with the S&P 500. We talked a little bit about someone who is looking for that 5-ish% yield, right? Like that's really interesting to a lot of people, but like who is like the perfect scenario as it relates to like portfolio construction is going to really be using these products, right? Who, like as a percent of portfolio perhaps, or risk tolerance, any sort of characteristics you can describe as like your target customer would be really beneficial.
Sure. So I whenever I talk to advisors, and we talk to a lot of advisors on a weekly basis, they all have different ways that they allocate for their clients, whether that's, depending on an age or what they're looking for, if that's income or market growth. But we kind of design these, having an equity, core bond, and a cash to slide into many different parts of your portfolio. So if you're just, not at your, call it income generating phase of your lifetime, these can still work for you, whether it's, SPYI coming in and getting that extra income, you could put it towards something else you want to buy every month. But you still get that market appreciation. So a lot of people we talk to, one, they're looking for income. So the first and foremost, they're like, these are income products. They fit into our income products. Some of them look at them, specifically CSHI, as more of a cash alt product. but that can provide that monthly income. But overall, it can really slide into your, we go back to the 60-40 portfolio, but it could slide into any part of that, whether it's income, or just market appreciation, or just slicing off a piece of what you have in your equity, bond, or cash portfolio, and adding this in will give you a little more income, and dampen your volatility of your portfolio.
Got it. And to me, it really seems like SPYI could even substitute SPHD in someone's portfolio, right? The high dividend, low volatility ETF that I think is pretty popular. Yeah, because to your point, I mean, I just pulled up the chart here. Volatility is low, right? It's just kind of doing one of these, the ebbs and flows, but it's not doing one of these like we've seen over the last 12 to 18 months in the market. This has been really fun. So
Yeah.
now I want to ask you this final question that I ask every single guest that comes on here, right? Is in 12 months from now, what do you think people are going to be referring to when they say to themselves, oh, how did I miss this trend? It was so obvious, right? What is that trend that is happening right now that is so obvious that people just like aren't paying attention to?
Yeah, it's a great question. I think it comes back to what we were talking about earlier, and too many people that we talk to are just sitting on a lot of cash. And I think when they're looking at it, they're like, yes, maybe I could roll treasuries or move around in different types of savings accounts. And I think a year from now, people are going to realize that for the past year, they could have earned a 4 or 5% return just by owning T-bills or some high yield savings account. And they're going to be like, I can't believe I missed out on the opportunity when I just had all this cash sitting here. I think there's just too much cash on the sidelines. And I think people, even conservatively, can put it to work, whether it's a product like ours, like CSHI, or some other way, if they want to actually sit there and roll treasuries on every month or every 3 months or something like that. I think people are going to be bummed that they missed this, especially if the Fed is doing what they're doing, and then maybe who knows, maybe they're coming to an end of the rate hikes, and everybody's talking about, all right, next year in 24, are they going to start cutting rates? I think it could be a missed opportunity for at least the next year or two, where people are sitting on too much cash.
That is a really, really good answer. I've asked that question to more than a dozen people, and that was probably one of my favorite answers. I really like that. Right. Love it. Thanks so much, man. Also, wait, where can people find you? How do they learn more about NEOS investments? Where can they learn about your ETFs?
So they can just go to our fund website, neosfunds.com, and they can dig in. There's plenty of materials on there, fact sheets, data on the funds. Look up our 3 ETFs out there. But yeah, we wanted to start with these 3, but we have many more in the works. So you'll see them coming down the pipe.
Sounds good, Troy. Thanks everyone for tuning in, and I'll see you in our next episode.
Thank you.